I've been in the share market for a long time, but I don't have a long period today to discuss my entire lifetime story. And generally, I start at the age of 14. I've never actually spoken about what happened to my life prior to 14, here at least with 21st Century. At 2 months of age, I moved with my family to a caravan park. For the first 18 years of my life, I was living in a caravan park. Not in a caravan. I want to make a big distinction about that upbringing. My grandparents bought a caravan park at the age of 2 months, when I was 2 months of age. Now, I grew up in Terrigal. Anyone come from Terrigal or the Central Coast? It's about an hour north of Sydney. There was 3 caravan parks in Terrigal, and this was the worst one. This was a tough one. There was different types of people that lived in the caravan park, and a lot of them are still my mates. When I was about 12 years of age, a bloke hung himself in his caravan. About the age of 14, I turned up from school and there was police all over the caravan park. This was my backyard. I lived in the house in the caravan park, and they were all my mates. The police were all there because there was a person that was murdered on the caravan park, and he was cut up and put into a wheelie bin. So at the age of 13 and 14, I was introduced to a few things that not everyone get exposed to. But one of the biggest things when it comes back to wealth was the fact that my mates and their parents would have extra kids because they would get greater benefits from the government. My grandfather that was running the caravan park, he would have to catch them on a Thursday afternoon as they left the caravan park, because the majority of them would spend their entire 2-week pension at the pub that night. Yet they had 4 or 5 kids living in a caravan park. One of my good mates is still a good mate of mine right now, was brought up in that caravan park environment, actually in a caravan. He's now a chief economist at Commonwealth Bank of Australia. And why I tell that story is that it's got nothing to do with the outlook of my life or what I've been through, but more so, Robert, that's gone on to great success. Here in Australia, we are extremely lucky. Irrespective of the story, the environment that you've been raised in, each and every one of us can go on to great success. What's going to dictate your ability to go on to great success, though, is your ability to go through the ups and downs of the marketplace, go through the ups and downs of life. Because everyone goes through the ups and downs of life. And it's not who you are as a person in a position of comfort or security. It's who you act in times of trouble or uncertainty that is critical. I'd imagine the majority of us have an upbringing greater than living in a caravan park. Robert, I'm not too sure what he earns now, but as a chief economist at Commonwealth Bank of Australia, I'd imagine it's a fair amount. He did give a gift back to his parents. They did move out of the caravan park, and they've been able to retire, living in quite a comfortable house. And it's not a huge house, it's just a comfortable one that suits them. And that's the greatest gift that you can give your parents. I started on the share market at the age of 14 because my mum gave me 1,000 shares in Woolworths. 1,000 shares. I want to creep bat, gave me 1,000 shares in Woolworths. So I look up happy in the dictionary. There wasn't a big smiley face of me at the time. I now look back on that gift, though, and realise it was the greatest gift my mum ever gave me. So for every parent in this room, Christmas is coming up. I encourage you to give them the greatest gift that you can. And that is, one, an education. So the education you've been taught over the last 4 days. And likewise, buy them shares. Buy them shares. Because it was that first gift of owning stock, not something that you can read out of a textbook, that hired my greatest lessons in life. I've got more letters after my name that's in it. I graduated from university at 19 with a Bachelor of Commerce with a major of Finance. I've got postgraduate studies in advanced investment and finance. At 19, I was approached at university by a stockbroking firm. At 22, I was paid a lot of money to go work at Macquarie Bank. The reason they paid me a lot of money, not just as a salary, but as a sign-on, was because of the investment philosophies that I'm going to teach you today. 3 years for Macquarie Bank, I decided to move away from the investment banking world and to follow a goal of mine, which was to set up my own company. Now, that's what money is all about. It's creating dreams. I was able, by following my investment philosophy, to create many options in my life. And the greatest option was to go ahead and set up my company, and that many people thought that was going to happen at the age of 50. Well, I made it a reality at 24, 25 years of age. 7 years on, we are the fastest growing investment services company in the country 3 years in a row. We've been recognised by a few different industries as leading the industry from a level of ethics and integrity. From ethics and integrity, that's very rare that you find those sort of trades when it comes to investment markets. Like in 2008 alone, 2008, 1 year, the average super fund fell 30%. $300 billion was wiped off Australians' retirement savings in 12 months alone. Back to ethics and integrity of investment markets, how much money do you think financial planners lost in 2008? Nothing. They make money. If they make you 30%, they get paid exactly the same amount as if you lose 30%. What about a fund manager, the people that have made investment decisions? How much money did they lose? Nothing. They still made money. Average fees, super fund, 2%. They've lost you 30. $300 billion was wiped off Australia's retirement savings, and yet they've walked away with a huge gain. Is that a good scenario? It's rubbish. It stinks. Like, if people charge that way, I live in Sydney. I now in Manly. I catch the ferry in the jet cat to and from work. Anyway, it's a great way to travel to and from work, but the problem with Sydney is that 95% of people are employed in investment markets, and they all charge exactly this way. Those people should go to work wearing a balaclava. It's dead set thieves. In life, it's very easy. In business, it's very easy. You find your passion and you add a lot of value. People will pay you a lot when you add value, and you should charge a lot when you add value. Now, if you add no value to people's life, what do you deserve? Nothing. So we changed investment markets. Where we make money is a profit-sharing arrangement. It's 10% of anyone's profits. So if you start with 100 grand, I turn it into 200 grand, I get paid $10,000, you keep 90,000. Is that fair enough? Is everyone happy to share 10% of the profits that I generate with me? My goal is very similar to each and every one of you in this room. Who here is to make money and make a lot of money? If I make every one of you a millionaire, is everyone happy for me to become extremely rich because of it? Yes. If I make you nothing, though, what do I deserve? Nothing. 10% of nothing is how much? Nothing. What happens if I lose you money? 100 grand portfolio, how about I take 100% of the downside risk? You have a 100 grand portfolio, I'll write out the check if we lose any money. So 100% of the downside, you keep 90%, I keep 10. Is that a good deal? Yes. This is why we're so successful. And I'm not silly. I've talked about, and we'll talk about how I can minimise the risk on the downside. That's what I do. That's all it is. And in 2006, 2007, I made almost $1 million a month. Almost. The last 3 or 4 years, I haven't made a cent. I haven't made a cent because I need investment markets to go up. And they say the share market should go up 4 out of 5 years. Well, for the last 4 years, it's gone down. That means the next 16 years, hopefully going to be pretty rosy. Often, though, many people concentrate on the problems that great opportunities present in investing. Do you think many people are looking at the opportunities that exist in the global markets today? Or the problems? The problems. Let's go through investment markets. There's a disclaimer that's the most important thing you need to read, and it's generally in the smallest font. I learnt that very early in the days. Let's talk through it. I'm going to be talking about investments. I've put the investments together, and as I said, how I make a profit is through 10% profit sharing arrangement. We do charge an upfront establishment fee of 2%. That covers the entire investment term. That's basically to ensure that I can keep my lights on. It covers all my expenses of putting through the product disclosure statement, all that sort of stuff. So it covers the cost, you get 90% of the upside, I'll get 10%. General advice. That means I obviously haven't sat down or considered your individual personal circumstances when I put together this presentation. But following on from here, the next few days you get an opportunity to sit down with some of our Queensland advisors to go through how you can apply these investment circumstances to your personal investment circumstances. Everyone follow that? Yep. Did that come out right? There's a few photos in the presentation. I also refer to Warren Buffett a lot. In my book, The JB Way, there's 118 pages and there's 140 quotes of Warren Buffett. Right, he does know I exist, but he's not out there saying that he endorses our products. There's also reference in the presentation. I went to Newcastle University, so one of our great girls from Newcastle is Jennifer Hawkins. There's a photo of Jennifer Hawkins. She doesn't know she's in my presentation, and just between you and I, I'd like it to stay that way. Sample strategies, we'll go through a few case studies. They do involve a few assumptions, but we'll talk through those assumptions so you know what we're talking about at the time. Today's presentation is to give you all the upside potential return that I think that exists in the market. Likewise, the maximum you can lose. We can quantify that day one. It's only when you have the maximum risk, likewise upside potential return, can you make an informed investment decision. So I've written a few books. Making Super Sexy. Who thinks super is sexy? Super turns me on. It is great. Who likes paying tax? None of us like paying tax. If you earn less than 37 grand, money you put into super, as of the 1st of July next year, tax-free. Pay no tax and contributions to super. If you're over 60, you retire. What tax rate do you pay on income from super? Zero. Nothing. What about capital gains? Zero. Pay no tax. Tax paradise. Super is sexy. JB Way, you'll all get a copy of the book. I've got a fair few copies there, so if you want to grab a copy of both those books, then by all means grab one on the way out. I'm all about educating you. I've only made my job, I've only achieved my job if you actually take a step, overcome those fears, grab your hairy coconuts, and actually make an investment decision. That's only when I should be making a profit also. People educate a lot of people, and only 5% of the people actually take action and do something with that education. I believe knowledge is power, but only when it's applied. Everyone follow that? You can have all the knowledge in the world. The last 4 days, I'm sure you've been instilled with a huge amount of strategies and education. They're only powerful, and this weekend only becomes beneficial if you actually take action and do something with that education. Yeah, we've got offices in Sydney, Melbourne, Brisbane. Yeah, offices in all different states and different regions. As I said, BRW, fastest growing company. We also were a finalist in the top 3 Australian Business Awards out of 1,600 nominations. So it's good to get recognised that we're doing something positive. 1950s, I believe life is about progression. Progression. In every aspect, life is about growth. Whether you're talking about wealth, relationships, or health. My grandfather taught me this when he was alive. He passed away a few years ago. He was a very good mentor of mine. I never met my father in my life. I'm a twin. My dad found out that we were having twins, and as soon as he did, the next day it was just dust. He disappeared. But I'm thankful my dad decided not to be part of my life because I had an outstanding, phenomenal relationship with my grandfather because of it. He passed away a few years ago. We shared a room in my upbringing after my nan passed away. He's a phenomenal man. He said, secret of life is growth. It's got to do with understanding where your comfort zone is. Educating yourself, and sometimes education comes out of textbooks or experience, and overcome those comfort zones to expand. That's simply life. Life is about growth. Right, let's go back and talk about a few different sectors and different industries that we've seen so much progress over the last 60 years. 1950s. Apparently that was a TV. Does anyone remember that as a TV? Yeah, there's one person, 2 people that would own up to it. You look at where we are today, life's about progress. Now, this is a TV I bought around 12 months ago. I found out that the cost of progress is that they become very outdated very, very quickly. Like now you can get huge TVs, a few millimetres thick, they're amazing. And they cost you nothing. Pretty much nothing relative to where it was a few years ago. Life's about progress. 1950s, this is an aeroplane. If you wanted to fly from Australia to London, how long would it take back in the 1950s? Days, 4 or 5 days if you're lucky enough to afford the ticket. How did the majority of people travel from Australia to London? By ship back in the 1950s, didn't they? How long did it take by ship? Months. Like, could you imagine now? Call you, mate, I'm going to London. Oh, yeah, oh, that's great. What airline are you flying? Oh, I'm not going by plane. So, well, how are you getting there? So, I'm going by boat. Like, it's not even offered anymore, is it? Life is about progress. Now, I've been meaning to change this next photo because if you're flying on this airline, it'll probably take you months to get there too. However, if it wasn't grounded, if it was in the air and the thing was able to fly and not have engine problems, you should be able to fly anywhere in the world within 24 hours. Life's about progress. It's amazing what opportunities that opens up. Like you go back, in the 1950s, if you're in business, who was your target market? 1950s, your target market, if you had a business here on the Gold Coast, would generally be those companies or people that lived within 5-kilometre radius. Today in business, who is your target market? The globe. We've become one global economy very quickly. Has it been quickly or has it been an evolution over the last 60 years? Another thing that's opened up the world to business and investment opportunities is the progress of computers. Apparently this was one of the first computers back in the 1950s. It was organised to manage the payroll of a company that employed around about 100 staff. Now looking at this photo, 1, 2, 3, 4, 5, half of them were probably paid just to ensure the computer stayed in operation. Life's about progress. Where are we today? Who here has a BlackBerry and an iPhone? We all do. We all do. We're walking around with a computer on our back pocket. How has that changed our life? Well, I was really apprehensive in taking on an iPhone, or a BlackBerry was the first one I had. Despite being in investment markets and a huge need for information, I didn't want the iPhone to come in and intrude in my personal space with my family. I fought it. I fought it long and hard. And then eventually I succumbed to peer pressure and I got an iPhone. And my fears came true. I went home, I'd be playing with the kids, I'm on my iPhone. I became addicted to information on my iPhone. Anyone else have the same sort of problem? I got to a stage where my wife said, hey, look, you can't have your mobile phone. You come home, you put it in the drawer. I said, look, babe, look, I'll prove that I need my iPhone occasionally. Look, how about I'll prove that I can do two things at once. Instead of taking the newspaper to the toilet, you let me take my iPhone, right? So she goes, okay, you can use it on the toilet. I go to the toilet 5 or 6 times a day now at home, right? And I'm in there half an hour each session. It's amazing how technology, I can sit on the throne, right? And I can buy shares on my iPhone just as easy, just as quickly, this is on the New York Stock Exchange, as quickly as a person on Wall Street can. I'm doing it from my toilet. Hasn't life changed? Is life about progress? I'm not too sure about that just yet.
Welcome to my office.
My grandfather did point out, though, that not everything about life is about growth. Sometimes progress does occur and things involve shrinkage. And one of those things has been in female swimwear. This is what they wore in the 1950s. And thankfully, life's about progress. Now, if that trend continues, where are we going to be in 10 years' time? That's a pleasant thought. Investment philosophy. 1952, Harry Markowitz came up with a theory that the more returns you seek, the greater risk you need to take on. Risk and return are correlated. He then won a Nobel Prize in economics with coming up with a theory of diversification. Now, in the 1960s, 1970s, 1980s, 1990s, diversification was relevant. You go study now, first year investment philosophy, first year economics, first year accounting, first year finance, they teach you the rules of diversification. Third year, fourth year, university, diversification. Go to advanced investment philosophy, guess what they teach you? Diversification. The 9-day financial planning course, guess what the majority of it's about? Diversification. Diversification is the aim to reduce risk. Diversification works because often asset classes are uncorrelated. What that means is if shares go down, what would generally happen throughout history at least, to property? Property would go up. Conversely, if property didn't go up, what would happen to shares? It would go up. Harry Markowitz realised this correlation, or inverse relationship between the majority of assets. He then looked throughout history and saw there was a few times, not many, but a few times where both property and shares would go down in value because there'd be a problem in the domestic economy. This is where advanced diversification came in. He said we can minimise that risk by investing offshore, because generally if you invest in the United States, Europe, Asia, Australia, they all work in different cycles, which means if the Australian property and share market fell, the United States might be booming. However, we've learnt the lessons that diversification is outdated. All asset classes today are correlated simply because of globalisation, simply because of the speed of travel, the speed of the internet. Information flows so quickly. Like you look at 2008, United States property market fell 70%. What happened to the United States share market? Fell 45%. What happened to the Australian share market? Now, we didn't have any problems in our domestic market or banking system. Yet what happened to the Australian share market? Fell further than the United States. It fell 55%. And we've seen in history, looking back in hindsight, the effects that those issues have had throughout Europe and Asia. We've become one global economy. Because of the internet, because of the speed of travel, all asset classes are today correlated. Another issue is that underpinning shares and property across the globe is debt. So if there's a debt issue, everything's going to plummet. So we've learnt the hard way, many people, that asset classes are correlated. Harry Markowitz's investment theory is outdated. So you go back to the 1950s. Everything in life has been about progress, except for investment philosophy. Today, we're still taught the same stuff. It hasn't provided protection against a thing. $300 billion was wiped off Australians' retirement savings, just here alone. If we looked across the globe, it's in the trillions. And more recently, the last few months, we've seen the issues of sovereign debt crisis. Again, everything has fallen. If you're following diversification, unfortunately, you're reducing your risk and you're reducing your return and increasing your risk directly. Diversification is outdated. It's rubbish. Everyone with me? First lesson, diversification, cross it out, outdated. It was valid 50 years ago, even 10 years ago. But because of the speed of travel and the internet, it's gone. Gonskis. What is another alternative? Because equity markets, property markets involve a lot of risk. They can go down and go down substantially. How can you avoid that risk? Well, let's look at diversification first. If this is what your portfolio was worth in January 2008, 12 months on, this is a balanced super fund. 12 months on, that's all that would have been left of it. Following Harry Markowitz's modern investment theory, diversification has been a protection against nothing. Warren Buffett also states that diversification is merely a protection against ignorance. If you don't know what you're doing, spread your assets across everything. Because eventually, if you've got across everything, you're going to get lucky and you're going to be unlucky. But the unlucky ones is only going to be a small portion of your portfolio. How do we look at reducing risk? There is a better way. And everyone in this room has been following this investment philosophy. Everyone's been doing it, not to your assets, but a liability. You've talked about the entire weekend and heard, I'm sure, about protection, about insurance. The evolution of investment markets is as simply that. You insure your car. Now it's just about time you insured your biggest assets, whether it's in super or outside of super. $300 billion, that could have all been avoided with insurance. That's all my investment philosophy is. I've made a lot of money on the share market and I lost it very quickly. Now, I wanted to enjoy all the pleasure associated with the share market without the usual pain. With insurance, that's how I can achieve that. 2007, 2006, I made almost $1 million a month, as I said. Of course, I'm only going to make huge returns if I'm having a big swing on the share market. Everyone follow? You've got to go outside your comfort zone. But when the market plummeted, fell 55%, I was able to minimise my losses simply because I had insurance. Insurance gave me the comfort to have a lot more money exposed to the market for years beforehand. Everyone follow what I'm teaching? Everyone understand this? Investment success has got nothing to do with how much money you make when you get it right, but more to do with minimising your losses when you're wrong. And you will be wrong, especially in the share market. Now, I used to take it personally. But then I looked around and realised that I can't control events like the earthquake, tsunami and nuclear meltdown that happened in Japan earlier this year. I can't control what the United States bankers do. I can't control what the European politicians do. Things are going to influence the market moving forward that's going to work against you, irrespective if you think you're bulletproof, irrespective if you eat, breathe and live the share market like I do. You're going to get it wrong. And all it's got to do is buying insurance just in case you are wrong. That's all my investment philosophy is. Jamie said, come here and talk for an hour. It's like, well, I've told you, it's 4 words. Buy stock, buy insurance. Simple. Now let's have some fun. Who likes playing games? Yeah? Okay, it's going to cost you 20 cents. Has anyone got 20 cents that I could borrow? Because unfortunately, I left it out of my pocket. That's my way. We buy insurance on your shares or your super to minimise the usual high risks associated. By having insurance, thank you, you can have a lot more money invested in the market. Then you can also consider borrowing inside your super or outside your super to accelerate returns. By having insurance, leverage becomes a very powerful investment tool. You get all the upside of the market without the usual downside risk. If we can hand out those sheets, that'll be great, please. It's pretty simple, isn't it? Is this rocket science? Da Vinci once said, the most sophisticated things in life are often the simplest. I'm not coming up and telling you that you need to spend 4 years as an apprentice to trade options, CFDs, or advanced derivatives. All I'm saying is adopt what you're doing with your motor vehicle to that of your biggest asset, certainly your super fund. And when you've got protection, everyone should have protection in Australia, I believe. Capital protection or insurance on your shares is the fastest growing investment vehicle in Asia and Europe right at this point in time. Because people realise diversification is outdated. They've learnt the hard lessons through the school of hard knocks. If I grab one of those forms, that would be great, please. Do we have a copy that I could borrow? Thank you. Okay, what we're going to do is start on the first game. Everyone want to play a game? Yes. Let's play the mug investor game, right? I'm going to give you all $100,000. Everyone happy to start with 100 grand? Yep. And you have to have You got to be in the market, right? We've got to have a go. You can't just sit on the sidelines in cash. So you need to then put on a wager. And we're going to flip a coin. It's going to go heads and tails. You've got to choose heads or tails. And whatever one comes up, you make money or lose money. If you make money, you've made what you bet, so you doubled your money. If you lose what you bet. Everyone follow? This is a pretty easy game, isn't it? Let's call it the Mugs Investor game. Everyone follow. So I need a volunteer. Who's going to be my tosser? Who's a good tosser? He looks like a good tosser.
I love you, baby.
This is your sheet, isn't it?
Yes.
It is, okay. Well, everyone place your bets. So how much are you going to bet? You've got to bet something. Let's call it $10, okay? You've got to bet something. And you can invest 100 grand if you like. So you can go all in, or you can have a small bet. Now, for a bit of audience participation, write down H if you're going to bet heads, or T if you're going to invest tails. But I'd also like, so to prevent cheating, if you're going to go heads, put one hand on your head. If you're going to go tails, put the other one on your bottom. It should be a bit red from spanking, or the person spanking it that was next to you. Everyone place your bets. We're going to do this about 10 times. 25 minutes together, which means I'm going to go about half an hour overtime. Thanks, Joel. Okay, everyone place your bets. Hand on your head or on your tail. What are you betting? What's your name? Michael. Yeah. You betting heads or tails? Heads. Everyone happy to back Michael as the investment manager. Who's backing him? Who's going heads? Who's going tails? Who thinks he's a hoax? Doesn't know what he's talking about. There's plenty of them that thinks you're a hoax. Toss it up, catch it, turn over. Let's see what it is. It's a tails. So if you've invested 10 grand and you won, you've made $10,000 profit. So your portfolio value would be 110 grand. If you invested 10 grand, you lost, it'd be worth 90. And because Michael lost, he can keep going until he wins. Now let's place our second bet. Good game? Easy game? Is investment easy? Yes. Yeah, of course it is. One thing that's not influencing your investment decisions at the moment is your psychology. Because is it 100 grand in the game a bit different to 100 grand in the actual investment world?
You lose your insurance as well, right?
Oh, sorry, it's the other one. It's not the insurance, it's the Mugs Investor game. Don't get ahead of yourself. We'll go to the advanced philosophy in a second. So everyone's on the Mug Investors page. Sorry, Michael. So you lose the full bet if you lose. Okay, place your bets. Let's go round 2. Michael, you going heads or tails? Heads this time. You've ditched tails. You went heads before, that's right. Tails never fails in New South Wales, but we're in Queensland. Okay, heads and tails. One in your head, one on your bum. Toss it up. It's a head. Michael is a good tosser. Good work. Who else? Next one. Who's got more than 100 grand? Who's got more than 200 grand? Anyone got more than 200? Anyone's got more than 150 grand? 120 grand? Few people? How much you got? 120? 140? Oh, yes. Give him a hand. You are the Bill Gates at the moment of the entire room. What's your name?
Neil.
Neil. Nice to meet you, Neil. Justin. Okay, seems you're the best tosser. Give it a go. Heads and tails. Place your bets. What are you going, Neil?
40,000.
40 grand. 40 grand for tails. That's a big bet. You're confident. Who's confident Neil's going to do tails? Who thinks he's going to not going to do tails and do heads? Okay, place your bets. Heads or tails?
You ready?
Yeah, yep. Oh, mate, that was a really premature. Tails it is. Good work, Neil. You won. Who else wants to have a toss? Actually, Neil, you'd still be worth the most, I reckon. You can keep going. What have we had so far? One tail and 2 heads?
Yep.
Coin's rigged. Who gave me that coin? Place your bets. Let's do it again. Who's going heads? Who's going tails? How much are you betting now, Neil?
Another 40.
Another 40 grand, and you're going?
Heads.
Heads. Oh, he's converted. Go. Oh, good toss, Neil. It's a tail. Oh, boom. Keep going, Neil. Keep going. These things happen, do they? If you treat investments like a hobby, they will soon become a very expensive one. Heads or tails? How much are you betting? Okay, what we'll do, we'll make this the last bet. Last one. You can go all in, It's the last bet. Who's going heads? Who's going tails? Who's heads? Who's tails? Where you go, Neil? How much you betting?
80.
80 grand. Boom. Is that all you've got left? No? Where you go then? Just leaving a bit on the sidelines just in case. Heads or tails?
Heads.
Heads it is. Is there anyone out of the game? Who's out of the game? Oh, how are you out of the game? Oh, doesn't it suck being out of the game? We'll give you a few more goes, Neil. Last go this time. We've got to move this on. I've got 21 minutes to go and I'm about 5 minutes through my presentation. Okay, last go. The more money you bet, the more money you make. Who's confident? Who's in? Who thinks it's the bottom of the market? The bottom of your punting terms? Ready? Toss, Neil. You going heads or tails?
Tails.
Tails. Tails never fails. And it's tails again. Neil, he's a great tosser. Who's out now? Oh, it sucks sitting on the sidelines. We'll go one more time, Neil. What are you in? Back up the truck. Actually, how much you got, Neil?
320.
320 grand. Who's got more than 320 grand? How much you got? $400,000. How much you got? 524 grand. You guys should be fund managers. Are you a fund manager? I doubt it. Okay, what's your name?
Mike.
Mike, last go. What are you going in?
Tails again.
Tails again. How much you betting?
200.
$200,000. Well, he's willing to have a big swing. Come on. Heads or tails?
Tails.
Tails it is. Keep going. Let's go again. You guys are geniuses. Who's worth a lot of money? Who's gone? Who's all out people sitting there playing on their iPhone and saying, this game sucks. This is a shithouse game. One more toss. We've got some great tosses in the audience. This is great. Heads it is. Throw it up. Tails. Oh, he's gone. Throw over the coin. Okay, who's got more money than they started with? Who's got less money than they started with? Oh, 50-50. Like if we really toss this coin, eventually it'll be 50% each. Who actually had an investment philosophy? Who applied a strategy? What was your strategy? $10,000 each time.
Always heads.
Yep.
Always
The problem is I find with investment markets, you look at the guys on the sidelines. How'd you end up on the sidelines? You went all in. At one stage, you backed up the whole truck. You never go broke if you go all in. If you're applying 10 grand, you've got 10 times before you're going to go. You'll go lose 10 times before you end up sitting on the sidelines. Who had another investment philosophy? What was your investment philosophy? Yep, you hope. 10% of your bank every time. 2% of your bank every time. Give him a hand. Can he ever go back broke? He can never go broke. Investment success has got nothing to do with how much money you get when you get it right, but more to do with minimising your losses when you get it wrong. Turn the sheet over. Let's play my game. Let's play my investment philosophy. I hope you've got a calculator because it could become extremely complicated. Okay, you invest the money, same game, right? But when you get it right, you don't make as much because you've got the cost of the insurance. Let's call it 10%. So if you invest 10 grand, you get it right, you make $9,000 profit. Everyone follow? Which is $10,000 less the 10% cost of the protection. If you get it wrong though, instead of losing all of your money, you only lose the premium you paid for the insurance. So if it was 10 grand at 10%, that would be $1,000. Everyone follow what I'm talking about here? Easy? Okay, well let's go to, who won the game? Who you ended up about, how much? 524 grand. Who's got more than 524 grand? 820. Anyone more than 820? Have we made a millionaire yet? Not a millionaire yet. 820. What's your name? Aaron. Let's go, Aaron. I'm going to have a punt with you, and you're going to be putting cost of protection in it because it's an expense now, isn't it? It's a cost. I'm going to challenge you. I reckon you're going to end up with more money this time than you did last. I'll even state that the majority of people in this room will make more money than you did in the last. And remember, we've got a big expense that we didn't have. That was insurance. What I want you to do, though, is bet everything every time. Not everyone else, just you.
So just the 100 there.
100 grand. Let's go 100 grand. Bet everything. Start tossing. Who's heads? Place your bets. Tails. You're going tails? Yep. How much you putting on? 100 grand. Go. Heads. Ooh. And I told you to put everything on it. How much do you lose? 10 grand. It's not everything. So you're down to 90. I want you to put 90 grand on the next one. If you don't end up more than 820 grand, we're going to be playing this game for a long, long time. If you won, you double your money, less the cost of the protection. The insurance. Everyone follow? Yeah. Easy? Who's got an iPhone? There's a calculator on one. Because they do everything. Everything you needed something to do, iPhone, get it out. If you don't have the app, download it. In 2 seconds, you'll have it. iPhones, amazing. Amazing stuff. Okay, let's toss. How much are you betting this time? 90 grand. Yep. What are you going, heads or tails?
I might go heads this time.
Oh, he's changing. Okay, heads. The only thing I can't control here is the investor. Damn. I'm putting my reputation on the line here. Is it heads or tails? Everyone place your bets? Heads it is. How much are you up to now? 180 minus 9, which is $171,000. 171. Let's put it all on. 171 grand. Our most successful fund manager, I'm not here to tell you how to do your job because you're a pretty good tosser to start with. I'm just hoping to improve it. Okay, heads or tails, 171 grand, you're all on. Scotty, I might need a calculator for the next calculation. Heads or tails, what are we going?
Heads.
Heads.
Tails.
Tails. So we're worth 153 grand? Something like that, aren't we? Yep. 153 grand. So we've lost 2 times and won once, yet we've still made 53% return. That's interesting. Heads or tails, place your bets. All in. Got to get it right soon. Heads or tails, place your bets.
Tails.
What were we?
Tails.
Tails, yes. Boom. Back in the game. We've won 50% of the time. All in again. How you doing with the calculations? 90% is pretty easy. Don't forget to use those tools, your iPhone. Hey, Joel, I'm going to go over time. Is that okay, mate? Actually, I'll ask you, do you guys mind if I go for a little bit extra time? We're happy to play the game? Perfect, thank you. We'll be here till around 12, but that's okay. I'll remind you that you all gave me permission. Okay, we all ready? Heads or tails? How much are you betting? All in.
All in. Tails.
What are we going?
Tails.
Tails, yes. What are we up to? What are we up to, Scotty? Who's over $1 million? One person, 2 people. We're 2 millionaires in the room. After 3 tosses, you've gone from 4 tosses, gone from 100 grand to over $1 million. You're doing well. Who's worth a lot more than they were the first time around? Who's worth less? A few people. A lot less, though. Going again? All in. How much have we got? How much do we have? 150, 300, 300 plus 90. You should be around about 570. 570. There's 3 types of people in this world. Those that can count and those that can't. I've taken that joke off Warren Buffett. It's a lot better when it comes from Warren Buffett. All in, 570 grand. Heads or tails, what are we going?
Heads.
Heads?
Heads.
Heads it is. We're over $1 million. Who's over $1 million now? Few people still working out the calculations. As an investor, you need to be able to calculate your returns. I know it's a bit tough, 90%. Is there anyone that's out of the game? Not one person in the room. Who has made more money than they started with the first time? Yet we're sacrificing 10% every time on cost of insurance. Speak to financial planners, they go, oh yeah, that insurance stuff, that's expensive. Well, how expensive was it not to have insurance back in 2008? One more time, let's go. What are we at? A mil. Who's happy to put $1 million in the market? $1 million. $1 million in the market. What about when you've got protection? Because even though you're investing $1 million, what's the maximum amount you can lose in this game? 100,000. 10%. So what insurance does, which is the most powerful effect of insurance, sure, it protects you on the downside, but it should give you a lot more certainty, a lot more comfort, a lot more security to have a lot more money invested in the market. Because even when you're wrong, what is the maximum amount you can lose? 10%. Irrespective of how many times you get it wrong, you're still always going to have money. You're always going to be in the game. One more toss to finish the game. Heads or tails? Place your bets.
Heads.
Heads it is. Did we win?
Tails.
Tails. Well, let's finish the game. Last go. We're below that. No, we're not below the 800 grand, are we? We'll be around 900. Everyone follow what I'm trying to teach you here. Capital protection is amazing. Who here is fearful of the share market or the scare market? With capital protection, you've got nothing to worry about. Your comfort is the 10%. Now, as a shareholder in a company, you're entitled to two things: the upside capital growth and also dividend income. If the dividend income covers the cost of protection, your risk is how much? Bugger all. So 10%, take off the dividend income, you're risking 1, 2, 3, 4, 5% each and every time. Sure, a company may not pay its dividend. If it doesn't pay its dividend, maximum you lose 10%. Guaranteed by the Australian share market, ASX. Pretty good counterparty risk, isn't it? Everyone, give yourself a huge pat on your back. Or a round of applause. Who ended up with a 20-cent piece? What'd you start with in the game? 100 grand. What'd you end up with?
900.
900. Did anyone beat 900 grand? What'd you end up with, sir?
4 million.
$4 million bucks. Anyone more than $4 million bucks? How'd you make $4 million?
I bet
Everything every time, and you just had a better bet than what he did. $4 million bucks. Congratulations. Well done. What was my investment advice to start with? What was your name? Aaron. What did I tell him? All in every time. All in. $4 million bucks. 900 grand. When he went all in. It's amazing what capital protection can do. And so-called an expense. It's the most powerful investment tool I can teach you. 8 minutes to go. I've told you everything I need to know. Let's have some fun. We just did. Throughout history, people have focused too little on the opportunities that problems present in investing. What are you focusing on right now? Who's looking at all the issues that exist across the globe? What's the issues in Greece? Great debt and they sleep for half the day. What's the issues in Italy? Great debt and they sleep half the day. What's the issues in Spain? Great debt, they sleep half the day. What about in Portugal? Great debt and they sleep half the day. Has these things changed? How long have they been sleeping? Centuries. If countries were treated the same way as companies were, these countries would have been declared broke tens of decades of years ago. Everyone follow that? Is it new news? This is old stuff. You know why? Newspapers sell more stuff when there's bad stuff written on the front page. Isn't that right? And because of how much information we get, because of these bloody iPhones, the market acts irrationally. Because it's not being dictated by the fundamentals of our economy. It's being dictated by the BS we read in newspapers. The market makes people stupid. Who believes you? Stupid, right? Boxing Day, few weeks' time, Australia-wide, Myer, David Jones, 50% off store-wide sale, isn't it? And what do we see that day? Like people give up their Christmas night to sleep out in the street. Like they may have a family similar to mine, but that's fair enough, irrespective of their motive. They're on the street because they're going to be there at 10 o'clock to open the doors. And they're going to be a stampede. You see this, don't you? Boxing Day, stampede. People run into the store to buy more shit they don't need. Why? 50% off. Who thinks that's good investment philosophy? It's great. Who here buys their Christmas gifts on Christmas Eve? We buy it knowing in 2 days' time it's going to be worth 50% less. Why do we buy on Christmas Eve? My 4-year-old will get a bit depressed if I say, hey, Santa didn't turn up today. He's still on his way. He gets here the day after Boxing Day, but I'm sure when he turns up, he's going to have twice as many gifts. Right? We like buying stuff at a discount. Share market, 50% off store-wide. There's the same stampede. It's the only store I know of in the globe that there's a stampede when it's 50% off for people running for the exits. They can't wait to get out. Here, have my quality big blue chip stocks because I can't deal with the emotions of the market. Most people concentrate on the problems as opposed to looking for the opportunities. Do you think there's a lot of opportunities that exist today to make a lot of money over the long term? Whereabouts? Which stock market? There's plenty of them. You can buy shares on the Libyan stock market. Right, they haven't been open for a fair while. But, when they were in a political stable environment, they were open like 3 hours a day and 2 days a week. Would you buy shares on Libya? Warren Buffett says, buy when there's blood on the streets. There's plenty of blood on the streets there. Because of the risks associated, you can't get capital protection on the Libyan share market. Share market, what about our backyard? Our economy pretty good? Let's have a look at our economy. October 2008, this was the headlines. Hitting the wall. Hell of a day. Front page of the paper, that was the bottom of the market. Best buying opportunity we've been presented with in 30 years. Majority of people sold. August 2011, over the cliff. Savers Dessert stock market. When you read these headlines, that's the time to be backing up the truck. To make money in the share market, all that you need to do is the opposite to everyone else. That is, if David Koch comes out in the morning on the Sunrise Show and said you should sell everything, what should you do? If Koshi comes out and says buy, what should you look at doing? The Koshi indicator. 53 billion crunch, giving you plenty of comfort. Warren Buffett, does he sit on the sidelines during these times? Warren Buffett is wealthy for one reason and one reason alone. That is because he's the tightest man alive. He is tight. He's cheap, right? He auctioned his car on eBay, right? Auctioned it on eBay and because he realised that he could get more money than the intrinsic value of that car because it's Warren Buffett, right? People bought paid a lot more for it. He donated the money to charity. And then he didn't have a car, so he was catching the bus to and from work. Susan, his daughter, said, we can't have that. We've got to go buy you a car. So dragged him down to the car yard. 2 cars there, right? Identical. One was $5,000 cheaper because it had suffered from hail damage. Guess what type of car Warren Buffett drives? Hail damaged car. Why would he buy a hail damaged car? It was cheaper. Cheapest man alive. Warren Buffett. Stock market. When was it cheap? Look at that fall in 87. Who bought on the share market after the fall and the crash of 87? Why not? It was cheap. 50% off. I'll tell you why I didn't. I was 8 years of age. My mum gave me the shares at 14, which cost me a lot of money for those 6 years. What about September 11? Who bought after the September 11 crash? Why? It was cheap. No wonder you made $4 million in the game. Right? Investment success has got nothing to do with brains. It's just acting rationally, isn't it? Oh, you don't look like the smartest tool in the shed. Perfect, see? You don't need to be the sharpest tool in the shed. All you have to do is act the opposite to everyone else. When Macquarie Bank, when AMP and all the fund managers are deserting the share market, do as our saviour does, the fund manager in the corner, you buy because it makes sense. Crash. GFC. Who bought after the crash? Few people, see? We're quick learners. It's taken us 30 years, but we're getting used to it. You buy when assets are cheap. You sell when they're expensive. Buy low, sell high. It's easy, this investment game. But to do that, you have to look down and decide when those headlines are on the newspapers whether or not you've got big hairy testicles or frozen peas. Right? You've got to be a vagina. You've got to be able to ride out the punishment and the ups and downs of the market. I'm not saying it to be crude, it's true, isn't it? You've got to be tough. Right? Testicles, weak, sensitive, no good. This is the share market. Plenty of ups and downs of the market, right? 1900, the longest, most painful, excruciating recovery in history. From the high to the low, back to an all-time high. The slowest in history, like over the last 110 years, has been just under 7 years. 7 years. Anyone know the high of the share market? November 2007. We're 4 years on. 4 years on. Who knows where we are in that chart? But what this means is that if it takes 3 years, longer than 3 years, to go create an all-time high, we'll be the slowest, most painful, excruciating recovery in history. For it to go up and create a new high, the market needs to go up 65%. 65%. Is it worse than the Depression? Is it? Well, is it? What was unemployment back in the Depression? 20%, 30%? I'm not too sure about you, but there would be no one going to the pub because discretionary spending, there was zero. Right? There was no jobs in the marketplace. There was nothing happening in the Depression. Like, Depression was tough. What's our unemployment rate at the moment here in Australia? 5%. Our economy is strong. Like, majority of people have got jobs. And they're feeling more secure about those jobs than they ever have in history. We're at the highest level of savings that we've seen in over a decade. Our economy is stable. It is strong. This is profits. Now, the only true long-term dictator of a share price is profits. That's it. If a company is not going to make profits, it'll eventually go broke. Everyone follow? In the short term, it is dictated as like a voting machine by the psychology of the market. But eventually, over the long term, the only true dictator of price is profits. This is from the ABS. Here in Australia, all companies across the board are making record profit. Record profit right now. Right now, we're making record profit. So if we're making record profit, shouldn't that mean price should be at all-time highs? That was if the market was rational. It was efficient. But unfortunately, the market is made up by the psychology and the noise exists and the BS that we read in the newspapers. Let's look at price. There we go. 2000, big bull market, correction, a bit of a recovery. That recovery was over 50%, I might add. Went sideways and then it's had a correction. I'm telling you, where we are today, it's the cheapest we've seen the share market in history. It's the biggest discount to profits that we've seen, even cheaper than where we were back in 2008. Well, I can tell you that, and I gain a lot of significance as an economist, looking at charts and then you overlay the two, right? Overlay two charts, oh, that turns me on. Price, orange line, green, price. When the green line goes over the orange line, the market is expensive. It's being dictated by greed. Everyone follow. When the orange line is below the green, the green line is below the orange line, market is cheap. Cheap because we're being dictated by fear. As you can see, the divergence, the differences between those two lines, that's the biggest we've seen in that entire period. And you go back throughout history, it's the biggest divergence we've ever seen. The market is at its cheapest. Every time the green line is below the orange line, you should be buying and buying big. Because eventually the two come back together.
What is the green line?
The green line's the share market, ASX 200. The ASX 200, the Australian share market, good point. The orange line is the profits of all companies in Australia. So I'm making an overlap there between the two. If you look at the Australian share market, the ASX 200, BHP, Rio, Westpac, National Australia Bank, CBA and ANZ, in those 6 stocks, that's over 50% of the Australian market and Australian companies. And each and every one of them have come out with record profit, haven't they? Record profit. Well, why are we trading at such a discount? If the market should be dictated on profit and profit alone, we should be back at these highs. Can it happen in 3 years? Yeah, it can happen in 3 years. What you'll find is that this sentiment is going to turn, it's going to turn on a dime. Last week, we've seen how sensitive the actual share markets are to positive news. The US share market went up 5% in an afternoon, 5%. Our share market is up almost 10% from the lows where we were a few weeks ago. For us to go back to where it was at the beginning of the year, the share market needs to go up about 17%, just to get back to where we were last year. All-time highs, 65%. Stop looking at the BS you read in the newspaper or the iPhone and start concentrating on the fundamentals that exist in our economy. And that is, we're at a discount. It might get cheaper tomorrow, it may get cheaper in a month, but provided you're taking a 3-year time horizon, I've got a fair amount of certainty and confidence that the market's going to be substantially higher than where we are today. Who agrees with me? Things are good here. Let's look at the United States. Many people say the United States is a terrible area to invest 12 months ago. It was very dark and gloomy over the United States, wasn't it? 12 months ago or 18 months ago. Share market's up almost 90% in the United States. 90%. Had you been sitting on the sidelines waiting for things to improve, then you would have been paying a very high price. Warren Buffett states that you pay a very high price for certainty, But uncertainty is the friend of an astute investor. Blue line is our economy, red line is the United States. Our economy as measured by the ASX 200, the red line is the Dow Jones. It's amazing. Our market is at a huge discount. United States, unemployment 10%, ours 5%. What's the United States interest rate? Anyone know? Official interest rate? Close enough to 0. Ours, 4.5%, maybe going down tomorrow. Why that's positive is that if we do slow down our growth and the government wants to stimulate buying and spending, they just drop interest rates. We can move interest rates and implement what's called monetary policy. The United States, they can't do a thing because they're almost at 0 already. Our economy is far more superior than that of the United States, yet the United States share market has increased almost back to those highs that they were at in November 2007. It's almost back to those highs. Does that make sense? Doesn't make any sense at all. It is nonsense. And I've got no story to make up to prove that could be okay or rational. All I can look at that and say, hey, there's one market that I'd like to be investing in and that looks cheap, and that's here in our own backyard. Everyone follow?